Good morning, everybody. Kirk Spano here, Investing 2020, Saturday, July 27th. We're going to cover a couple topics again, but with a lot of new data. Put together a slideshow for you today using several websites, but in particular, one called The Daily Shot. That is a pretty good website. It's a lot like the chart book over on Substack, probably the granddaddy version of it. So let's start with, just so everybody's clear on this, the Magnificent Seven versus the S&P 500. With the Magnificent Seven, the S&P 500 is up about 27-28%, and that is as of about a week ago or so. Come down just a little bit. The rest of the S&P 500 up about half of that. So half of the gains of the S&P 500 are concentrated in 7 stocks. So it doesn't take much of a sell-off in the mega caps to free up money to go other places. And that's what we've been seeing. That's what we talked about for a year would eventually happen. I'm surprised that the mega caps ran up so much, but 6 of those 7 companies, ex-Tesla, really are some of the best companies in the world. And the reason I don't put Tesla in that group is because they have far more competition and almost no edge on their competition. So it makes sense that they're losing market share all of a sudden. Tesla's down over the last 2 years by quite a bit, while the other Magnificent Seven stocks are up quite a bit. So take that for what it's worth. What we need to see is a reversal here. And this is a big disparity between the top end of the market and the rest of the market. This happens from time to time. It doesn't happen often. It's happened 3 times in the last 20 years. And every time, the mid caps and small caps generally rally pretty big if there's rate cuts in the economy and there's no recession. In fact, if there's no recession and we get rate cuts, the stock market 12 months later is up 19%, and that's the S&P 500. So if this relationship up here holds, where the mega caps lead 2-1, not so great for the other 493 companies. My guess is that you see that broaden out to 50 to 100 companies that are doing pretty well over the course of the next year as the rate cuts come. And by inference, you should have picked up on, I don't expect a recession. So let's get into the economic data. This is the Bloomberg Surprise Index, and you can see that all the surprises in the economy now for a while have been negative, and yet still no recession. Here we have some alligator jaws, and we know what happens to alligator jaws. Bloomberg Economic Surprise Index overlaid against the S&P 500. So what would we expect? We expect these to close. Now, does that mean that this has to crash? No. It just means that if it chops, remember, this is relative performance. If this chops and this comes up, the alligator jaws close. What could cause the economic surprises to start to be positive? Rate cuts, correct? So what we have seen, even though the unemployment rate has gone up 0.2% over the last couple of months, there are not really any new layoffs. Layoffs have not increased. So how did the unemployment rate go up if there weren't more layoffs? What's the answer? Anybody know? I bet you do. What you have seen is people entering the labor force. And this is a combination of 2 things. First off, we have had significant immigration, and some of them are counted in here. And in fact, I would say that this line is probably a bit higher because of the immigration and the people who aren't officially counted. But you've seen a lot of people re-enter the workforce since COVID. You know, one, my fiance has re-entered the workforce after years of basically we had a good time. And now she's selling real estate. So you're starting to see people re-enter the workforce, and it's relatively easy for them to do that as baby boomers retire. There's opening. So I believe, and I've pretty much nailed this one since college, I believe that we are not really in any dire threatening circumstance here with regard to employment. The underlying nature of the economy, which is seeing massive retirements for the next 7-8 years by the boomers, means that anybody who really wants to come into the workforce and work, it's pretty easy for them to do that. There are a lot of labor jobs at the moment. Those folks are making $30-ish an hour where I am. There are skilled trades jobs all over the place, and this has been part of the skills mismatch for over I'd say a decade for sure, but really going all the way back to the financial crisis. So going back to 2008, 9, 10, those folks, after they get out of their apprenticeship period, are making 40s and 50s dollars per hour. So those are $100,000 a year jobs. And ultimately, there are a lot of professional and management jobs, although a lot of the management jobs are getting soaked up by AI. But a lot of professional jobs, sales in particular, that just there's really a lot of those positions that keep opening up as the boomers retire. And this is not a temporary thing. So we really shouldn't expect a huge uptick in layoffs unless something really bad happens. And it's hard to see anything really bad happening. I know that people want to say, but the debt. Well, you know what? Everybody's got debt. So if everybody has debt, ultimately there's a resolution in printing of more money, and therefore your debt goes away. So, could that be inflationary? It could be. I'm guessing not, because the demographics are so against it. Can they find balance? Think about how inflation has worked the last couple of years. What we have seen is inflation come down despite that big debt. And even if they print money like they did during the COVID crisis, how easy was it for them to bring inflation back down? 2 years. 2 years to bring inflation back down. So I'm not saying there won't be fits and starts and bumps and bruises along the way, but I don't see anything horrible until we get the last boomers into the Medicare and Social Security systems. At that point, we have to come up with a real solution that fixes things pretty much for 60, 70, 80 years, because you got the millennials coming after that. Now, when you take a look at the shorter term, you want to see what's going on with debt. And there's been an uptick in credit card delinquencies and a little bit in auto loan delinquencies. And almost everybody who is having a problem is a renter, and they're unemployed. So renters who are unemployed are really the big problem in the economy, and it's just not that big of a problem from the standpoint of sheer magnitude. No doubt folks who are unemployed have it tough. What I would say is that there are certain problems in the economy that are probably not solvable. However, folks who do get out there and hustle can hang on. Now, is that the American dream? No. Should it be better? Yes. But does it start with being 30-something years old and walking out and saying, oh, I'm just going to fix things today? No, it starts much younger in life with education and skills and a smarter approach to how we prepare people for adulthood. And I think we're moving slowly in that direction. But again, there are fits and stops and bumps and bruises along the way. So none of these things are easily fixed. And unfortunately, we gravitate towards what we see right in front of our face and the short term versus really looking 5 and 10 years out to the next generation. Again, I think it slowly is getting better. I think it's been slowly getting better for a long time. However, I wouldn't expect any major changes in the very short term. With that being the case, what happens with the economy that has marginal improvement over a long period of time, but really is given to the forces of a shorter term economic cycle? Well, inflation swaps are just crashing right now. So the outlook for inflation really looks like it's aiming back down towards this 2% level and lower, which is where it was for a better part of a decade. My anticipation, and again, I've got a pretty good track record on this. My anticipation, because of what I'm going to show you next, is that inflation does jitterbug around 2% for a while, then probably ticks back up just a little bit. Why? Well, we are in an era where, again, inflation was super low, and it was super low before COVID too, and now it's a little bit higher. And it's a little under 3% right now, closing in on 2%. The problem is what I talked about a minute ago, was the debt. So while individuals have to deal with things like shelter costs, which are technically coming down. Remember I told you about a year ago there was so much inventory for rentals and new homes that housing costs would come down? That's what happened. Now, I'm going to tell you right now that if interest rates don't start to come down quick, this is going to ramp back up. So interestingly, lower interest rates would be better for inflation from what I can tell, because the major problem with inflation is in fact housing and shelter costs. If we can bring that down just a couple of percent per year for a while, that would offset all the other inflationary things that we're going to do that have to do with the US debt. So it's imperative that we see housing costs come down and energy costs not go up much so that we can inflate away the rest of this debt. And I'm not saying that's right. I'm saying it's necessary, and I'm saying that's what they've been planning to do all along. There has never been a case where we could purely grow out of our debt. When people promise to fix the economy so that we grow because we drill, baby, drill, and because I'm going to deregulate and cut taxes and that'll all pay for itself, I would just point out that in the last 50 years, nobody's been able to pull it off. Not Reagan, not Nixon, not Bush or Trump. None of them have been able to get their tax cuts pay for themselves. The only time that it actually worked was way back under John F. Kennedy, and this isn't a partisan thing, this is a circumstance thing. Taxes were just so high that a tax cut at that point actually did have the impact of paying for itself, but you were talking about tax rates that started double what they are now in the upper brackets. Right now, I would consider taxes roughly fair. Can you move around the edges a little bit, a point here, a point there? Sure. There aren't any major things you can do with the tax code at this point. The main thing that I see needing to be done is eliminating all the loopholes for people making over $1 million a year. And if I were running for president or advising one, I would say, look, frame it that way. We're going to leave all the tax rates alone. We're just going to get rid of all the tax loopholes for people making over $1 million a year that are avoiding income taxes and capital gains taxes and all the other taxes that they avoid. Same thing for corporations. Big corporations aren't going to be able to use loopholes. So if you're $1 million company and you're a startup, use every loophole you can. If you're an individual, maybe make the cutoff at $1 million. Loopholes go away after $1 million. Corporations, maybe you make it $1 billion. I don't know if these are the right numbers. I'm just saying the tax avoidance at the very top end is massive. And I've seen that if we eliminate just those loopholes that allow that tax avoidance, we can fix something in the range of half to 2/3 of the budget problem. And what do we know about the rest of the budget problem? It's interest on the debt. So simply cutting interest rates reduces that. Throw in growth, and we get back to that scenario that I've talked about, where we can have a balanced budget about 2030. Loopholes, growth, and lower interest rates fix interest on the debt and the housing problem. Demographics are deflationary, and that's the offset. So there's multiple moving parts that we've talked about a number of times. And if we can pull it off, we can get away from this extreme rhetoric about hating women and immigrants and anybody who's not a white guy. And I say that as a white guy who gets irritated with the slamming of everybody else, knowing that I'm a pretty lucky dude. I've had a lot of advantages in my life because people would open a door for me. And if you haven't realized that, if you're in a position like me, wake up. Now, I understand that a lot of folks don't get those doors open, regardless of color, or being a white guy. And that usually has to do with socioeconomic. It doesn't have to do with race. It has to do with, I'm not going to help a poor guy, I'm rich. Or he can do what I did. I pulled myself up by my bootstrap, right? So as people go through the process of self-realization, which is a few more percent of the people per generation, again, this is why I say that problems get fixed slowly, is we only fix them at the edges, at the margin, a little at a time, which makes it last a long time. It takes a long time to get it done. But again, I do think we're moving in the right direction. I've been studying this since high school. So I've got a pretty good use case over the last 40 years. I've been watching this stuff. And I can tell you, yes, things are better today than they were 40 years ago. Are they as good as they should be? No. Are there still all these other things? Yes. Bad things in our psyche. I just started watching the Three-Body Problem. Anybody watching that? I think it's on Netflix. Got all kinds of awards. It's just another show, this time about aliens who are going to get here in 400 years and they're going to take us over, and how they're messing with us now so that we don't have the science to beat them. The approach is to spend 400 years preparing for war and selling off assets to the wealthiest people so they'll finance that war effort for 400 years. Well, the aliens' problem with us is that we're just not very good, right? That we lie and cheat, steal. There's two solutions to that problem, right? Aliens are coming to get you, but because you lie, cheat, and steal. Should you prepare for war, or should you try to lie, cheat, and steal less? Maybe then they wouldn't hate you so much and want to just take over your planet. It's those types of things that play directly into the economy. So that as the economy ebbs and flows, as political rhetoric goes one way or the other, as corporations behave one way or another, incentives versus penalties, growth versus taking money out, right? Elizabeth Warren hates share buybacks, but sometimes recycling that capital is the better approach than to making a company bigger by being speculative, right? If a company buys back its shares or pays out a dividend, that's a return of capital to the shareholders. Then what happens? It gets reinvested somewhere else. It may be more efficient. So this idea that buybacks are bad is wrong, frankly. The idea that's right is that there's a whole bunch of executives, gaming the system and extracting more money in compensation than they'd be worth in 100 lifetimes because they can get away with it. It's their buddies in the boardroom. So if shareholders really wanted the system to work better, they would tell almost every executive who asks for some gigantic raise, no, look, this is a $10 or $20 million a year job, not a 50 or 100 million a year job. And if you want to make more money, then you make the shareholders more money. We'll give you restricted shares. Everybody has to win. And by the way, retirement benefits, pensions, things like that for the employees will be senior to corporate debt. That should be illegal. So we have skewed the system in a way that there's lots of easy ways to fix it if we choose to, but we don't generally choose to unless there's a crisis. And as we've seen, we get a periodic crisis and we try to fix things. The Basel banking rules, Dodd-Frank Act coming out of the financial crisis. And weirdly, the people who wanted those things put in place have backed off because of pressure from the organizations that would be regulated that basically want the rules the same as they were going into the financial crisis, more or less. Because, hey, we're different managers. I go through these historical lessons because I think it's important that we wrap our head around what really goes on. This ebb and flow between regulation and deregulation. In a country that's not terribly regulated because even though there are rules in place, which are good, we don't hire a lot of regulators. So only the most egregious things get caught, and almost everything that breaks just gets penalized in retrospect, right? If a bank goes under and the Fed missed it because they don't have enough regulators, or if there's insider trading and the SEC missed it because they don't have enough regulators, we just either throw somebody in jail or we bar them from an industry. And if there's any money left, we fine them. To my experience, actually, the system is fairly effective because there is enough disincentive for coloring outside the lines. The guys like me and almost any other corporation out there, we don't color outside the lines. Why? Because we get caught, right? Just beyond the ethical argument. But if you would get caught, penalties can be severe. So what ends up happening is only really the people who are willing to cheat, right? The disincentive is enough. I mean, the ethics of it are that I think over half of people wouldn't cheat, even if they could. I think it's probably way higher than that. And bad cheaters get caught because they're not good at it. So you're left with a very small subsegment of highly successful cheaters. And that's probably where we need to focus a little bit more energy. But the rest of it's probably relatively in balance. So when you hear rhetoric from the far left, from the Elizabeth Warrens and AOCs of the world, want to regulate the hell out of everything, it's just so unnecessary. And it stifles small business more than it stifles big business because big business has lawyers. Small guys like me, we don't want to spend 40 grand on a lawyer. But the big cheaters, the ones that Lena Khan goes after, probably need it. And what's interesting is she gets a lot of flack because she has challenged a whopping 2% of all the mergers that have been proposed in the last 3 years. 2%. And half of them have to cut a deal. So 1% of the mergers, 1% really get regulated. And she gets slammed by everybody. Now, I think the economic understanding of some of the things that she does, particularly related to the energy industry, don't make sense because that's just a train that's left the station and there's nothing really you can do about it other than create more energy using other means, which Joe Biden tried like heck to do with the IRA. And all those things play into inflation and employment. So when people promise this, that, or the other thing on one side or the other side, more regulation, more taxes for the rich versus cut taxes and deregulation, I will tell you it truly doesn't matter that much until you break things. And too far to the left or too far to the right will break things. We've seen things break on the right 3 times now in the last 40 years. Too much deregulation, too many tax cuts in the wrong spot that did not pay for themselves. The breakage on the left is more dragged out than the crisis that the right side creates, right? The the problems from the far right end up creating crises. It looks really good and then it crashes. The problem on the left is that it's just a perpetual drag, like you're pulling a rock uphill. And we have to find balance. And I think, interestingly, in a lot of spots we have found balance, and that's why inflation has come down quickly. Now, people say it's been 2 years. For an inflationary event, that's really quick. Remember, the 70s, we had high inflation for 7 or 8 years, mainly driven by oil from OPEC. Throw that in the back of your thinker. Don't ever want to get caught being dependent on OPEC again. Keep that in the back of your thinker. All right. So going back to this unemployment rate and the gross domestic product, what I have said to you over and over again, as long as we don't screw up employment, everything tends to work out. But if the unemployment rate suddenly would surge, we'd probably have a problem. Interestingly, the economy sped up in the second quarter. Second quarter speed up. Something about that rings a bell. Oh yeah, that's because the first quarter is usually pretty slow. How many times have I talked about down first quarter and then an up second quarter? Happens all the time. 2 out of 3 years, I believe. Just a thing. What does that mean for the third quarter? My guess is that the third quarter doesn't speed up at all. So just say, right now they're forecast, they just had 2.8%. I don't know what GDP now is. Somebody wants to go look real quick and tell me what GDP now is. My guess is it's about the same, or at least it should be. And one of the things that's helped keep the economy from really slowing down, despite all those negative surprises that we talked about earlier, is that business spending has been drifting up. In what is supposed to be a horrible environment for business, it's not. Business spending has been drifting up. So this is what the probabilities of a rate cut in September have jumped to 108%. I don't know. That must have something to do with leverage. So essentially what the markets are saying right now is that because they're afraid of unemployment more than they're afraid of inflation, and because they're seeing the negative surprises, they expect a cut in interest rates in September. And in fact, the market in this past week, especially on Friday, when the inflation numbers came in pretty good again, are pricing in a 50 basis point cut. Do you know somebody who talked about a 50 basis point cut? Oh yeah, it's this guy. So now I thought it should happen in July, and I thought it should have happened this meeting before that and the meeting before that. I thought we should be cutting interest rates since March. They don't call me. The reason I've thought that is because I would love to see the money out there on the sidelines that is earmarked for residential construction freed up. I can go down a list that I keep of 7 projects of between 40 and 600 units that are on hold near me. We need those houses. We need those units. And we need more home ownership to put pressure on rents. We need corporate ownership of single family homes to be taxed like hell so they don't do it. And we need Airbnb in cities where there's a problem with housing for the local authorities to keep cracking down. That's actually a good market by market regulatory approach, not really a federal answer there. There are places where Airbnb makes a lot of sense. There's other places where it doesn't. But what we have seen is more regulation on Airbnb and taxation and being subject to the same hotel fees that hotels are happen from city to city to city a little at a time, mainly the big touristy city. Then who is that good for? It's good for your renters because there's a few more rental units on the market, but it's also good for Airbnb gets less of the tourism business in a city. Who is that good for? Good for the hotels. That's why I have never told you to invest in Airbnb. I think that there are big secular trends against them. Teresa says that GDP now is at 2.8%. So what are lower interest rates good for? Small caps. And as I mentioned before, or I think I mentioned before, and if I didn't, I'll mention it now. In the 12 months following the start of rate cuts, if there's no recession, the S&P 500 is up 19%. However, the small caps are up more. And that's what this shows. So the odds of small caps being up 50% starting from the rate cuts, if there's no recession, is in his stat sample is 100%. I'd have to dig into that. This is Fundstrat, and generally they're pretty good at this stuff. So what they're saying is that small caps are going to rally hard, and we've started to see that, right? We've started to see that, and I would throw, and this is IWM, so that really includes a ton of mid caps too. And you can invest in IWM or XMMO, which is a really good value and momentum mid cap fund to take advantage of that. I will say this. I am looking for a correction in QQQ that I can buy because I do believe that most of the companies in QQQ are awesome, especially those biggest ones. The three cloud companies, right? Forever stocks, Amazon, Google, Microsoft, and they're AI leaders too. And then they have other business. Apple, best brand in the world. Meta, Facebook, which I'm becoming more impressed with. I don't like the pricing of the stock, but I can see where that company is going. And I think that WhatsApp is going to actually have huge penetration going forward because of the encryption and secrecy of those communications. You just have to take 5 minutes to turn off all the spam. QQQ is almost off by 10%, 7 or 8%, I believe. I did say a 10 to 15% correction is what I was looking for. So we're close, I think. I'm going to show you something in a minute. All right, I'm going to show it to you now. There you go. A lot of those charts were something called the daily shot. I have the full subscription, but they have the daily shot brief, kind of a light version. Also showed you the daily chart book over on Substack. If you want charts and you don't want to have to pay for anything, all the good stuff, is behind paywalls, but the almost good stuff, the pretty good stuff is free. So between the daily shot brief and daily chart book on Substack, you can get a lot of good information. And I subscribe to the premium versions of these. You don't need to. You got me. I'll give you the ones that matter. But this is pretty good stuff for your keeping up with the economy. Some of the places where I expect money to be made, natural gas prices are firming up. Oh, I lost my headline. Oh, I lost it. Anyway, there was another headline from the Wall Street Journal out of FFTT this week. Let me go grab it real quick. Oh, lock me out. Okay, so natural gas is going to go up because we need it to fuel more power plants. And then the Wall Street Journal points out how utilities, and there's a chart on this too that I don't have, but utility spending is the highest ever in history this year and next year. Remember, I told you the CapEx cycle would be tough on the utilities. I told you this years ago. Well, the CapEx cycle is starting to kind of even out with revenues coming up and CapEx flattening. So as CapEx flattens and then slowly drifts down over a decade, but revenues go up, the lines cross. So we're at a point now where there are a few good utility stocks that I would buy. And I gave you one this week that I am buying because of a special situation that I think is going to cause it to double or triple on top of a 7% dividend over the next 5-ish years. But what does the Wall Street Journal say? As the grid becomes increasingly unstable due to age and extreme weather, folks, a few years ago, climate change didn't exist, according to the Wall Street Journal. They're citing it in a lot of articles now. That is a secular trend. The damage from climate change, the immigration from climate change, are all things that we have to wrap our heads around on a constant basis because that is where the big money is going. That is where the capital spending is going. That is where the new gigantic business is going. It's tech, it's dealing with aging demographics, and it's dealing with climate change. Always repeat to yourself these huge secular trends. Fourth industrial revolution led by AI, the impact of aging demographics on the economy and the social welfare structure, federal budget, and then the impact of climate change on a myriad of things, on businesses, on governments, on immigration. If we just keep going at those three things over and over and over again, and especially if we can figure out how the fourth industrial revolution will help fix the other two, which is what's going to happen over a long period of time, we can avoid all those stinker stocks, which are 80% of the stocks out there, and focus on the top 20% of the stocks that have secular trends in their favor that we get a chance every now and then to buy at the bottom of a cycle. The cycles are the fractal nature of investing. You have the giant trend, but then you have the wiggles in the line on the way up or down. And if you can invest at the bottom of a cycle and right at the top of the cycle, a position trade, it generally takes years, and then you take a break for a year or two as the correction happens after some FOMO rally, and then you get back in. As long as you stay on the right side of the secular trends, you're going to win. But if you can trade the positions over longer periods of time, but not super long periods of time, right, over a year or two or three, instead of a week or two or three, I don't do that. Shooter does. He's good at it. I'm not good at it, and I'm not interested. I'm happy making my 20, 25, 30% a year with a lot less effort than a trader, puts in. So this presentation today really is about understanding those giant trends, the slow nature of improvement, how we have to avoid the extremes because that really wrecks things from time to time. Stay away from rhetoric going into 10 weeks of high rhetoric. I want you to focus on the investments that you can make during the rest of this quarter as people get flighty with whatever they get flighty with. Don't focus on the politics. Cast your vote and find good investment. That'll make you happier in a year than anything. So Shooter put out a new format for the major markets. I want to show it to you. He covers what the trader narrative is right now, which is usually some sort of bullshit. And then he talks about Treasury. And we cover long-term treasuries because what are long-term treasuries? What are long-term treasuries for us? What are long-term treasuries for? Insurance against recession, exactly. So when you think about having long-term treasuries in your portfolio, you should only be asking one thing. Does a recession look likely in the next year or two? And I would say probably not. Now, more into the second half of the decade, maybe, we'll see. But I think this rate cutting cycle is much more geared towards the short end of the curve. Why? Because we've had an inverted yield curve for a couple of years now. And it's started to get to the point where it's almost flat because the long end of the curve, it really belongs between 4 and 5%. Can it go up and down a little bit? Sure. If some of the dollar collapse, pound on the table, inflation is going to be higher for longer, people who were just wrong again, right? Inflation happened because of why it happened because of COVID, but it wasn't higher for longer. Pretty much gone again. So we just lived through a period where the inflationistas, the inflation hawks, the dollar collapse people for 15 minutes were right, and then suddenly they're wrong again. Why is that? Why have they been wrong for 40 years? Because it's a shit theory. The United States economy is so strong that it's almost impossible to bring down. Now, the thing to watch out for, and there was actually a good blurb in Forest for the Trees this week, is all the people who want to crush all the people that want to crush the Chinese economy. That is a stupid approach to international relations. Stupid approach. It's economic warfare. What does economic warfare always lead to? Ask a German. It leads to real warfare. Now, while we don't want China to outcompete us and use government subsidies to take away our jobs, again, I will point out that the fourth industrial revolution means that a machine here or a machine there is just a machine here or there because the labor to run the machine is lower now than it was in the past. So overcoming the logistical problems of getting something from point A to point B becomes a bigger part of the equation. Therefore, if you're going to build something, you might as well build it closer to the end consumer. And what do we have in North America? A lot of end consumers. Mexico is a young population that if they can really ramp up like they've hinted at for a few years now, it's a great market to sell into. It's great arbitrage in a number of different ways. So the idea that the inflationistas are going to be right because they're printing money, man, well, they haven't for 2 years, man, is that they're going to continue to be wrong. You're simply going to have deflation and inflationary forces offsetting. The deflation of demographics, the inflation of budget to deal with the demographic. And technology is going to help with a lot of those things, but it won't necessarily always be the technology players. Some of it will be technology players, but a lot of it's going to be the companies that use technology well. And that's what we should look at. So as far as the 10-year treasury goes, is it all that attractive to us? No, not really. Can it get up to here someday? Yes, it can. But until we anticipate a recession a year or two off, it doesn't make sense to buy this. Now, let's suppose we get another inflation scare and it comes back down in that 80s range. Then maybe. But there's just not a lot of money to be made on this. And really, most of the money made on treasuries is on an options trade for the most part, or a margin trade, because from 90 something to 120, 130, it's not a real big gain. It's a one-time thing. You have to time it pretty well. And I did time it really well once. I bought a whole bunch of, actually twice. I bought 0 coupons in 1999, which paid off during the dot-com crash. And I bought treasuries in 2007, which paid off during the financial crisis. Went up like 20, 25, 30%. If you want to lock in 4.5% interest rates, have at it. I don't know why you would. Now, he described it real nice. So he's got a new approach to how he lays it out. He's got the wave counts and structure, support and resistance levels, technical indicators, volume analysis. He goes through all of it. Talks about the dollar. I do think the dollar is going to come down a little bit. He's basically saying it'll be choppy, which I more or less agree with. It's kind of where we've been for a while. As long as, this is the range that I call the millennial dollar. I think that we're going to be like this for a long time. Here's the fun one, S&P 500, right? We don't want to own this because maybe 50 companies in it are worth individual stock investment. Maybe 100, I guess, if you're really generous with your criteria. Target wave 3 isn't much higher. It's almost right at what my prediction was for the start. Mine was 572. He's saying it's going to head to 569. Add 20% though next year because of rate cuts, right? It's another 100 points. Gets us into those low 600s, like I talked about, being the top of the S&P 500 during the next cycle. And then I think the S&P 500 enters a choppy period that lasts for a while, years. Let's get to QQQ because this is the one that we might want to invest in. Looking for a pullback. Here's the top. Here's where we are now. Still not that big of a deal. I was targeting 455 on QQQ. It's at 459 right now. Maybe it's at close at 462. So we closed in on my target of 455. Haven't quite got there. But I have an extended target, and I really think that there's a good possibility that QQQ gets into the lower 400s, largely because of just a couple of giant stocks getting pulled down. So another 10% maximum. The idea that we'd have a national bear market where it hit 20% correction, hard to wrap your head around because they're going to be cutting rates in September. So between now and the September rate cut is when I would expect QQQ to sell off, especially if Jay Powell isn't quite so clear in what he says and he keeps the market guessing, which I'd love for him to do this time. So the chart indicates that QQQ is in intermediate wave 2, which means downtrend, of a large wave 3 up, which means there's still more to go to the upside, but it has to have a little correction period, right? Fractal, the wave within the wave, the move within the move. So he calls equality 447. I said 455. Different approaches, similar number. But I've also talked about lower 400s, and he has an extended correction down to 417. I'd say that's about right. I actually changed my QQQ limit orders from 455 to 420 for that reason. Now, if the world suddenly starts to get better, I can just change it to a market order. If something goes wrong, QQQ could get under 400. I'm still probably, unless there's big downside momentum, I'm probably still buying over here. Talks about the target wave up is to over 500 at some point. If you can get in down here in the 400 and teens, then that's probably as good as you get. Again, unless something really goes wrong. Then he has a different Fibonacci and support levels. A Vulture price, 324 on QQQ. What is the Vulture price? The Vulture price is, hey, a bunch of stuff goes wrong, an event. What if we have a terror attack? What if China does get aggressive somewhere? What if Russia launches a tactical nuke? What if the war in the Middle East expands? A lot of things that could create an event. But understand that if you get prices like that, you probably want to really get in. And a financial crisis collapse, could he go even lower? So he has this out, and you have to think of it in terms of probability. The odds of the end of the world happening are, relative price single-digit percentage, low double-digit percentage that we get the Vulture levels, and then the other 70% likelihoods are all these upper numbers. So when you take a look at QQQ, when was the last time we got end of the world pricing? Well, I guess it was just 2022 correction. It was lower than that during COVID. So that's not very end of the world, is it? And I showed you a longer term chart where it looks to me like the large caps are forming a big head and shoulder. So markets don't always go up. There are periods where for 7, 8, 9, 10, even 15 years in history, the markets have round tripped. I don't know what this round trip will look like. I don't know what low in the future will look like a low in the past. My guess is that the floor levels of 2016 that I worried about for years are now 2018 and 2020. So the range of the market in 2018 and the range of the market in 2020 are probably as bad as it can get, even if we have a financial crisis, just because of all the money that's out there. And ultimately, because of the chart I showed you about the federal budget and what we've been talking about with the budget is that quantitative easing is coming. I don't think it's coming in the next year or two unless there's a banking crisis, but I think they've done a good job with the banks. And I think that once the banks start to merge, and I was talking to Chris DeMuth about this last week, and I'll have that interview this week for you. There's a lot of good bank investments, but there's a handful of great ones. And certain community banks are very well positioned. So people can say, oh, look, they had more loan losses. Right. That was their kitchen sink quarter. Do you want to buy the other banks that are going to have the same problems before their share prices come down? Or do you want to buy those banks after their share prices come down? Because the banks will ultimately get fixed, because the government and the Federal Reserve are both on their side. And the smart ones, the ones that are managed well, the ones that understand what blockchain is, understand how to use the internet to drive efficiency, and aren't gigantic so that they have a hard time turning the ship, are going to do well. And the consolidators are going to do well. Fifth Third is interesting to me, but I really think that New York Community Bank Corp is the one that I want now. If the whole sector got beat up, I think Fifth Third would be my next. And then there's a few others. Somebody asked, do I see real estate finance pressures impacting banking stocks this year? It's already happening. We've been seeing banks get beat up for a year and a half. So will we see one last, sigh out on the banks? Probably. That's why I say if a bank like Fifth Third gets caught in a wave that's affecting the whole sector, you probably buy it. The one that's basically worked its way through the process with sharper lines, which gave us an opportunity to buy cheap, is New York Community Bank Corp. The other banks have been smoothing things, just taking it a little bit at a time. Ultimately, that acts like a drag on them for a long, long period. As an investor, you'd rather see them just deal with everything at once, in 1 year, like New York Community Bank Corp is doing. Remember, they're only 9 months in to their corrective period, and they just had a kitchen sink quarter where everything else got thrown in. They have like no possibility of negative surprise anymore. I mean, I guess there's always something, but I mean, they did everything they could to just say, okay, that, all those things, let's write them down. And the bank stock barely moved. A little bit of traders being traders, but you didn't see anybody big get off. And the institution's been buying that stock. And again, if the whole sector gets hit, I mean, everybody knows what's going on in commercial real estate. There's no surprises there. So if there's no surprises and the Fed starts to cut rates, that means the price of the buildings that they have to sell are going to level off. They're going to stop falling, which appears to actually already have happened from what I can tell. And I follow that because, it's a side hustle. I would love to see some bank out there collapse and take the whole sector down. And then I'd probably buy Fifth Third, and there's a few others. You want to buy the consolidators, the ones that can expand their footprint and sell branches, right? So if a bank can move into a new region that has some overlap, right? Not a lot of overlap, but some overlap, so they can reduce the overhead, combine websites, have a wider reach on the internet. I mean, that's where banking is headed. Banking is headed towards, and I see one bank doing this in town here. Banks are going to have fewer offices. Those offices will have more services, but you're not going to have the little personal banker at every corner. You got to do real banking, drive 10 miles, figure it out. Otherwise, everything else can be done online and with a Zoom call or a little chat bot. We are the most overbanked nation in the country. It's not even close. We have way more banks per capita than anybody else. A lot of it has to do with private wealth accumulation and families buying small banks. And a lot of those families don't have heirs to run those banks anymore. And it actually doesn't make sense for them to keep the banks from a financial standpoint. It makes sense for them to sell and then just have the money for other things. Sometimes for reinvestment, sometimes stupid idiot, spending heirs, whatever. Every family is different. Like I said, there's a family here in town. They don't have an heir for their little bank. So it makes sense for them to sell the bank or remutualize it or turn it into a credit union. It doesn't make sense for them to be a standalone little community bank anymore. And that story is playing out all over America. And the regionals that have some scale need to merge so that they can be part of the, Fed is going to help you gang. All right. So my barbell right now is on the one side, and this is for equities. I want QQQ, and then I want SMID caps. That's what I want. Handful of large caps to go along with QQQ, but not many. And at the moment, I don't want QQQ. I'm waiting for a deeper correction. And then if you're going to make this multi-dimensional, make sure you have Bitcoin, because the digital gold argument just keeps getting stronger. You're going to see a headline. Go ahead and mark this minute. I know there's somebody on the YouTube channel that does this. Mark this minute. You're going to see a bigger headline. If you read the Russia stuff, it's already happened. The China stuff. But you're going to see a headline. This is what it's going to say. Such and such a nation settles an oil transaction with Bitcoin. It's coming. It's already partially happening. with a little bit of Bitcoin around the edges. But I think what you're going to see is one of these countries, some emerging market that was early in Bitcoin, is going to use some of their Bitcoin to buy something big or bail themselves, wipe out their debt or something. It could be that. It might not be oil. It might be pays off the IMF with Bitcoin, right? It's going to be something like that. And at this point, again, I just don't see how Bitcoin doesn't go to 300,000 in the next few years. Beyond that, again, it has to do with at what price does it become an international currency hedge that is generally accepted? Because I'll tell you, after a brief weakening period, the dollar is going to get even stronger than it was last time. So if you don't own Bitcoin when the dollar gets super strong and you're in some other part of the world, we're exporting our inflation to you. And that is what currencies do. They import or export inflation. So when the dollar gets super strong again, maybe in the 2030s, and breaks the records that they just set or breaks the levels that they just broke, has new highs compared to recent highs, then everybody else gets our inflation in the 2030s. There's a lot of demographic things that have to shake out over the next 50 years, 60 years. And I'd like to see a bunch of them. Hopefully I last that long. But if you wrap your head around the demographics and the technology and the energy and the climate change and how they all play together, you keep finding big winners. Speaking of big winners, on Monday, we are specifically going to talk about AST SpaceMobile. I hope you read the note that I put out. I had a talk with their president and chief strategy officer the other day. Wasn't allowed to record it, but I did summarize the conversation in that piece. I know that we're up 300, 400, 500% depending on where you bought it and what you got in premium on AST SpaceMobile, and people get tempted to sell. I think that's a bad idea. I think that you should probably expect me to tell you that anytime AST SpaceMobile dips before it's 20 billion in market cap, you probably want to buy it or sell the cash secured puts. The way I modeled that out is I see that company being worth about 70 to 100 billion dollars by the end of the decade. And I think I was pretty darn conservative. I think that AST SpaceMobile will be at least as big as Verizon, AT&T, and American Tower, which are all between that 50 and 100 billion range. I actually think Verizon and AT&T might be a little bit above that. But based on the way they're pricing things and the way the revenue shares work and what the margins are, and the fact that the satellites only have to be replaced about once a decade, it's going to be a cash flow machine because there are literally 3.5 billion potential customers that have no broadband right now. Right? They have cell phones, but it's just for talking, and they're very, very limited on the downloads, 2G, 3G speeds. And these satellites can handle 4G and 5G. And what I didn't know, and I'll go into this more on Monday, just read the article and we'll talk about it. I'm going to do a presentation on AST SpaceMobile on Monday because, it'll get me eyeballs, but it's important because this has become a big position for us. It is hard to see AST SpaceMobile not on the S&P 500 in 4, 5, 6 years. That's a 4 to 5 bagger from the current price after a run-up. So anytime it exhales, you probably want to sell put. I wouldn't be writing covered calls on this thing. If you did, because you didn't listen to me, keep rolling them out a month at a time or 2 months at a time until a dip helps you expire it. There's just no reason to get cute with something that can go up the way that it does. And if all of a sudden it's 30, 40, 50 billion in market cap, then we start talking about figuring it out. But before then, I didn't want anybody making a trade before Monday or on Monday morning. People have been talking about it. Don't think of this like Nvidia. It's a similarly sized market. There's $1 trillion a year, or 1.1 trillion a year in cell phone revenue. That's going to double in the next decade. And it's largely going to be because 3.5 billion people, ex-China, ex-Russia, would like to have 5G. And this is a company that can bring it to them. And they have huge first mover advantage because SpaceX ain't anywhere close. All right, have a good afternoon. I'm going to go visit my 90-year-old uncle today. And I may take a look at his cars. He's the one that collects cars, and I don't know, mess around. All right, everybody, have a great day.